All right, today we are jumping into a really fascinating and, let's be real, a pretty controversial theory about how the financial markets actually operate. The core idea? That everything most of us see is basically a carefully built illusion, and that behind the curtain, there's a secret engine pulling all the strings.
Come on, you know the feeling, right? You put on a trade, everything lines up perfectly, and then bam, the price just whips down, takes out your stop loss to the exact tick, and then, only then, does it rocket up in the direction you knew it would go. It feels personal. Well, according to the theory we're digging into, it just might be by design.
You know, from the very first day we start learning, we're taught about these tools. We draw our trend lines, we watch for those moving average crossovers, and we're told it all comes down to simple supply and demand. This is the bedrock of pretty much all conventional trading.
But what if those tools aren't the engine at all? What if they're just the paint job on the car? This theory argues that all these common concepts are nothing more than a facade, a distraction, specifically designed to hide the real way price moves from almost everyone.
So to really get this theory, you first have to accept its central premise. The market isn't one big, happy family. It's actually split into two completely different groups. And we're not just talking big players and small players, we're talking about the informed and the uninformed.
So on one side, you have what this model calls uninformed money. Think of this as the herd. It's retail traders, it's the gurus you see on social media. They're loud, they're very visible, and they're the ones who believe in that facade. But on the other side, you've got smart money. This group is quiet. They're hidden. These are the big banks, the major institutions, the ones who actually provide the liquidity. And according to this theory, they aren't just participating in the market. They're engineering it. They are the engine.
And check this out, because this slide really shows you the power dynamic. The theory claims that even though the uninformed money group is huge, like 95% of participants, their actual influence is tiny. It's that little 5%, the smart money, that holds all the cards. They aren't just passengers along for the ride. They are the ones driving the car.
This quote from the source material just says it all, doesn't it? It calls this small group the drive shaft of the entire market. So while the herd is busy thinking their collective buying and selling is what moves price, this theory says, nope, it's this tiny, hidden group that's actually turning all the gears. So the theory basically throws down this challenge, this metaphor. It paints the market as this ecosystem where one group is the predator and the other is the prey. One is the lion, the hunter, and the other is the lamb, which in this model is the liquidity. That's the pool of stop-loss orders and breakout trades that the hunter can feed on. It's a pretty stark way to think about it.
Okay, so if smart money is engineering the price, then how do they do it? This is where we get into the nuts and bolts of the theory, a systematic process it calls the interbank price delivery algorithm.
Now get this. The idea here is that you are not trading against the random, chaotic emotions of millions of other people. Instead, you're trading against an artificial intelligence, a program that delivers price in a highly structured, totally non-random way. And it does this by following a very specific, repeatable four-stage cycle. And here they are, the 4 stages. That's the whole shebang. It all kicks off with consolidation. You know, when the market is quiet and going sideways, that always leads to an expansion, which is a big, strong move in one direction. After that, price will either retrace, pulling back a bit, or it will just reverse its direction completely. That's the loop. The first, and honestly the most important rule of this whole sequence is this. A quiet, consolidating market isn't just taking a nap. According to the model, this is a period where orders, liquidity, are being built up above and below that range, basically loading the spring for a massive move. That's why a consolidation has to be followed by an expansion. This means that certain moves are just impossible in this framework. Price can't go from a boring consolidation straight into a retracement. I mean, it hasn't gone anywhere yet, so what is there to retrace from? And it can't just reverse out of a consolidation either. It has to expand first. This one rule simplifies the whole predictive model like crazy.
So once that big expansion move finally happens, the algorithm hits a fork in the road. It's got only 2 paths it can take, and will either pull back a little, that's a retracement, before maybe continuing on its way, or it's going to reverse course and head in the other direction.
Okay, I know this might all be sounding a bit abstract, so let's make it real. Let's see how this 4-stage algorithm supposedly maps onto a typical 24-hour trading day, creating what the model calls a daily blueprint.
So you can see right here how the cycle lines up with the trading day. The theory suggests the Asian session is your classic consolidation phase. Then the London Open kicks in, and that often brings a manipulative move to hunt liquidity. That means triggering all the stops above or below that Asian range, right before the day's first big expansion. The New York session often continues that move, and then the London close, that's frequently where you'll see a reversal.
So what this is really arguing is that the daily highs and lows, all that volatility we watch every single day, it isn't just random noise. It's a structured, repeatable, and completely engineered process that's just cycling through those 4 stages day in and day out.
Now, as you can probably tell by now, fully buying into this model isn't just about learning a new strategy or adding an indicator. It really demands a fundamental change in how you see the market itself.
And the source material is super clear about this. It calls for nothing less than a complete paradigm shift. To actually use this model, you have to be willing to let go of the conventional tools, you have to leave that herd mentality behind, and you have to start looking at the market through a totally new lens.
In this final quote, man, it just perfectly captures the all-or-nothing approach here. It's not about adding one more thing to your chart. It's about throwing the old chart out completely and trying to align yourself with how the smart money supposedly sees the world.
So we'll end on this question. Whether you look at this model and see a total game changer, or you just think it's an interesting theory, it forces you to think about the assumptions you make in your own trading. It paints a picture of 2 different worlds, the facade and the engine. The only question left is, which one are you trading in?